Chapter 10 is long-term assets, both fixed and intangible. So we've been over it before, but just as a refresher, fixed assets are long-term or relatively permanent assets, such as equipment, machinery, buildings, land, etc. And fixed assets are used in the normal operations of the business. So they're used repeatedly, they have long lives, and they're relatively permanent. The cost of fixed assets is the purchase price plus all costs of acquiring those fixed assets. So that could include any freight costs, any installation costs, etc. So back in chapter 6, I believe, there were questions about why we include freight as part of the cost of merchandise. It's using the same concept. So the total cost of something is whatever you purchased it for plus the costs of acquiring it. So it could be freight costs, but it could also be installation costs. But it's important to note that only costs necessary for preparing the fixed asset are included in the cost. So any unnecessary costs that do not increase the usefulness of the fixed asset are not recorded as expenses. So if the people installing it dropped it and it caused a problem and you had to fix that, you wouldn't include that. That would just be an expense. If there was any sort of vandalism, that also wouldn't be added to the total cost. It's just the purchase price plus any necessary costs of acquiring the fixed assets. And that's important to remember going forward. Okay, so fixed assets are depreciated, and depreciation is the decrease in the usefulness of fixed assets, except for land. We do not depreciate land. We'll depreciate machinery, equipment, buildings, etc., but we don't depreciate land. So depreciation is the decline in the usefulness of fixed assets, and we allocate a portion of the fixed asset's cost to expense over the asset's useful life. So over time, as we use the asset and it becomes less valuable, we allocate a portion of the fixed asset's cost to an expense every year as we move forward. And how do we record that? How do we journalize it? It's going to be the following. And we went over this in chapter 3, but now we're going to go through it again. So you are always going to debit depreciation expense to account for the fact that this is an expense, it's the decline in usefulness of the fixed asset, and then we are going to credit accumulated depreciation. And as a reminder, accumulated depreciation is a contra asset account. And a contra account, if you remember, is contrary to its related account. So a contra asset account is contrary to an asset account, and in this case, it's whatever the fixed asset is that you're depreciating. And contra accounts have the opposite signs as their related accounts. So an asset is normally debited to increase and credited to decrease. So accumulated depreciation is going to be debited to decrease and credited to increase. So that's why we're debiting depreciation expense to increase that, and we're crediting accumulated depreciation to increase that. And then another important concept, especially when we're doing one of the depreciation methods that I'll tell you about in a minute, is book value. So book value is equal to the fixed asset account minus the accumulated depreciation. So it's basically the net value of something. So it's what it originally costs, so that's whatever the value is in your fixed asset account, minus the accumulated depreciation is what it's worth at that point in time. So what it was originally worth minus how much depreciation has accumulated is the book value. And then down below, right here, is the journal entry if we had $1,000 of depreciation over the course of the year. So on December 31st, you would debit depreciation expense for $1,000 and credit accumulated depreciation for $1,000. And that's always what you're going to do for the basic depreciation entry. Okay, so now we're going to focus on where you get the actual amount of depreciation from. So you know how to do the entry, and it's pretty straightforward, but how do we get that $1,000 from up above? How do we know what the depreciation expense is per period? Before we go into the different methods, there's some terms to define first. So the initial cost is the purchase price of the asset plus all acquisition costs. So that's what we reviewed at the very beginning. That's an important factor in computing depreciation expense. The expected useful life is the estimated length of time the asset will be used in normal operations. And this is kind of like an industry statistic type figure, so it might be this specific machine we know has a useful life of 5 years, or this equipment has a useful life of 7 years, and you'll be given that expected useful life value. Residual value is the estimated value of the asset at the end of its useful life. And usually I get questions about, well, why isn't it 0? Why don't we depreciate it all the way? It depends. There's a lot of different reasons. Sometimes it's a technological type reason. So maybe we know that in 3 years, the asset might still work, but it'll be kind of obsolete and we'll replace it and get a new one. So at the end of 3 years, it's still worth something, but we're probably going to get rid of it. That's the end of its useful life for us. So that's why the residual value might not be 0. It might be a different figure. But regardless, the residual value is the estimated value at the end of the useful life. And then depreciable cost is this. It is initial cost minus residual value. And that is the cost that is allocated over the useful life as a depreciation expense. So with these terms in mind, we are going to run through 3 different types of depreciation methods. So the first is the straight line method. The straight line method provides for the same amount of depreciation expense for each year of the asset's useful life. So every year the value is going to be exactly the same. If you look at it in the book, there's like a little chart and it does something like this where you have time down here and the amount of depreciation up here, and maybe it's years 1, 2, 3, and 4. Each year you're going to have the bar go up to the same height under the straight line method because your depreciation expense is going to be exactly the same in each year. So how do we calculate this? The formula is pretty simple. Annual depreciation is equal to the initial cost minus the residual value, which you might recognize as the depreciable cost, which I talked about earlier. That's up here, depreciable cost. And that is divided by the useful life, so the number of years of useful life. You can also calculate it using what's called the straight line percentage, and we'll use this in a later method, but the straight line percentage is 100% divided by the number of years of expected useful life. And then once you get the straight line percentage, you would multiply it by the depreciable cost. Both of these would give you the same answer for the straight line method, so it's up to you. I can show you both ways in the example problem below. So it tells us that a machine was purchased for $25,000 with an estimated residual value of $5,000 and a useful life of 4 years. Using the straight line method, determine the depreciation expense for year 1. So the first way is depreciation expense is going to be equal to initial cost minus residual value divided by the expected useful life, and that is a figure in years. So that would be the initial cost. It was purchased for $25,000 minus the residual value, it tells us is $5,000. And it tells us it has a useful life of 4 years. So if we do that calculation, we will get $5,000 per year in depreciation expense, because that's your $20,000 up above divided by 4 years is $5,000 per year. So in year 1, the depreciation expense would be $5,000, but it would also be $5,000 for years 2, 3, and 4. And like I said, you can also use the straight line percentage method. So if you wanted to do it that way, your straight line percentage is going to be equal to 100% divided by the years of useful life. So that would be 100% divided by 4 years. 4 years. So that's 25% a year. And then you multiply that 25% times the depreciable cost, which is $25,000 minus $5,000. So $20,000 times 25% is also $5,000 per year. So whichever you'd like to use, they both get you the same answer. Okay, so that's the straight line percentage method. That's the straight line depreciation method. Next, we have the units of activity method. So the units of activity method provides for the same amount of depreciation expense for each unit of activity, but it will provide for a variable expense for each period. So the straight line method gets you a fixed amount per period. The units of activity method is going to be a fixed amount per unit of activity, but since there's different amounts of activity per period, it'll get you a variable expense each period. How do we calculate this? Well, there's 2 steps here. First is depreciation per unit, and this is pretty similar to the straight line method. Again, you start with your depreciable cost, so that is your cost minus residual value on the top, and now you're dividing it by the total estimated units of activity. So that could be miles if the asset is a truck, it could be hours of a machine, anything like that. And that gets you your depreciation per unit of activity. And then your total depreciation expense is going to be your depreciation per unit, which you calculated up here, times the number of units for the period. Okay, so I'm going to use the same example so you can see how it changes under each method. So, again, we have a machine was purchased for $25,000 with an estimated residual value of $5,000. And now instead of the number of years of useful life, it tells us with an estimated useful life of 10,000 operating hours. During the first year, the machine was operated for 2,000 hours. And we again are trying to determine the depreciation expense for year 1. So our first step now is depreciation per unit. And that is going to be our initial cost, so $25,000, minus the residual value of $5,000, divided by the total units of activity. So that is the 10,000 operating hours. And that gets us depreciation per unit, and that is going to be 20,000 on the top divided by 10,000 on the bottom is $2 per hour. So $2 of depreciation per hour that the machine is operated. So our depreciation expense for year 1 is going to be depreciation per unit times the units of activity for year 1. So that is going to be $2 an hour times 2,000 hours equals $4,000 for year 1. Okay, so that is the units of activity method. And now we have the double declining balance method. And this method is an accelerated depreciation method. So it is going to provide for a declining periodic expense over the expected useful life of the asset. So you're going to have more depreciation up front and then less in your later years. And the reason a company would choose to do this is mainly for tax benefits. Okay, so this is the procedure for the double declining balance method. Your first step is to determine the straight line percentage. So I told you that above. It's 100% divided by the useful life. Okay. Then you determine your double declining balance rate, and that is going to be the straight line percentage times 2. After you have your double declining balance rate, you compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. And this is important. It's the book value of the asset now. It's not the depreciable cost. It's not what we've been using so far. So that's going to be a difference. And then also important to note, the asset cannot be depreciated below the estimated residual value. And I'll show you what I mean by this in this example. Okay. So again, it's the same initial setup. We have a machine that was purchased for $25,000, an estimated residual value of $5,000, and an estimated useful life of 4 years. Now we're using the double declining balance method to determine the depreciation expense for year 1. So our first step is to figure out the straight line percentage, and that is going to be 100% divided by the 4 years of useful life, 25%. Then we get our double declining balance rate. So that's the straight line percentage multiplied by 2. So 25% times 2 is 50%. And then the third step, we are multiplying the book value times the double declining balance rate. So that is going to be $25,000 is our initial book value, because if we remember, book value equals the initial cost minus accumulated depreciation. So in year 1, there hasn't been any depreciation yet. We're calculating depreciation. So our book value is just the initial cost, and the initial cost was this $25,000. So $25,000 times 50% is $12,500 in depreciation expenses for year 1. So year 1's pretty straightforward. Years 2 and 3 are where it gets kind of tricky. So the depreciation expense for year 2 is going to be, again, the book value times the double declining balance rate. But you have to figure out what the book value is in year 2. So the book value in year 2 is going to be the initial cost, which was $25,000, minus accumulated depreciation. So in year 1, our depreciation expense was $12,500, so we have $12,500 in accumulated depreciation, which makes our book value $12,500. So in year 2, our depreciation expense is the book value of $12,500 times the double declining balance rate of 50% equals $6,250 for depreciation expense in year 2. And now for year 3, we're going to be considering this, which I told you about above. The asset cannot be depreciated below the estimated residual value. So what do I mean by that? Depreciation expense in year 3. If we went about it the normal way, we would say, okay, what is our book value in year 3? Well, our book value is going to be the original $25,000 minus our depreciation from year 1, which was $12,500, minus our depreciation from year 2, which we just calculated, which was $6,250, equals $6,250 as our book value for year 3. Then, normally we would do $6,250 times 50%, which would get us $3,125. But we know that our residual value is equal to $5,000. So if we depreciated it the normal way, we would get the $3,125. We would have depreciated past the residual value, and we can't do that. So instead in year 3, we are just going to depreciate the remainder. So we are going to just depreciate what's left between our book value and the residual value. So that is going to be this $6,250 book value minus the residual value of $5,000 gets us depreciation in year 3 of $1,250. And then we're at $5,000 as our book value. That's the residual value. We stop depreciating there. So that's kind of where it gets tricky. But before that, you just need to be remembering that you need to calculate the book value each time. It's going to change each time. And then what we did in step 3, in year 3, you can't depreciate below residual value. And those are the key points for double declining balance method. And as you see, you depreciated $12,500 in year 1, so that's a lot. Then it decreased to $6,250, and then it decreased to $1,250. So you pay a lot of depreciation up front, and then it declines over time. Okay, so some other topics to cover. First, we have repair and improvements to fixed assets. So there are 2 types of repair improvement type things we can do. The first is called revenue expenditures. So these are costs that benefit only the current period. So those would be things like ordinary maintenance and repairs. So getting the oil changed for a truck or a car or something like that. That does benefit and that does improve the fixed asset, but only for the current period. It's not any sort of new addition. It's not an extraordinary repair. It's not a real improvement. So when we have revenue expenditures, we're just going to debit expense and credit cash. It's just a normal expense for us. On the other hand, we have capital expenditures, which are costs that actually do improve the asset or they extend its useful life. So these are pretty significant improvements. The first type is extraordinary repairs. So this could be something like the overhaul of an engine in a vehicle. And the main idea is that it extends its useful life. So with an extraordinary repair, since we're extending the useful life, it's going to impact depreciation. So how do we handle this? We are going to debit accumulated depreciation to reflect the fact that we're taking away some of that accumulated depreciation because we're extending the useful life. Maybe we depreciated it $100,000 worth of accumulated depreciation. We're going to add some of that back to say, actually, the book value of the asset is higher because we extended its useful life with an overhaul of an engine in a vehicle. So you would debit accumulated depreciation to decrease it, and then you would credit cash because you are paying for this repair. The second type is asset improvements. So this could be something like adding special parts to a machine. I think the example in the book is adding a hydraulic lift to a truck or something like that. So when you do this, you are going to debit the asset because now the asset itself is worth more. So you're increasing the value of the asset on your books and then you're crediting cash. So in all of these, since they're all repair and improvements and stuff like that, you're always crediting cash, you're paying cash, but what you do on the debit side varies. So if it's a revenue expenditure and it only benefits the current period, it's just categorized as an expense, so you debit expense. If it's a capital expenditure, it can either be an extraordinary repair, in which case you're extending the useful life, so you're going to debit accumulated depreciation, or it's an asset improvement in which you are actually improving the value of the asset, so you would debit the asset. Okay. Now we're going to cover the disposal and sale of fixed assets. So first, starting with just discarding fixed assets. If you're discarding a fixed asset, it means the asset is no longer used and it has no residual value, so it's fully depreciated. There's nothing else to it, it's no longer used, it's not worth anything, so you are just getting rid of it. And with the disposal of assets, the journal entry is as follows. You are going to debit accumulated depreciation to take it off your books, and you're going to credit equipment to take that off your books. So basically, you are just getting rid of it off your books. It's worth nothing, you're getting rid of it. So you do the opposite of what you'd normally do. Normally, accumulated depreciation is credited, you're going to debit it. Normally, equipment has a debit balance, you're going to credit it. And this will, again, one more time, take it off your books. It's important to note that if the asset has not been fully depreciated, you need to record depreciation first before removing the asset from the accounting record. After you do this and after you record the depreciation, then you do the following. You're going to still debit accumulated depreciation for the total amount because you want to get it off your books. You are going to, again, credit equipment or machinery or whatever it is. So those two steps remain the same. You're doing the opposite, so you take it off your books. But then you are going to debit the difference between the two to loss on the disposal of equipment, because you didn't use it for all it was worth. There was still some value left if it wasn't fully depreciated. You're just getting rid of it though, so you're not using that last bit of its useful life. So that's a loss for you. So you are going to record it as a loss on the disposal of equipment, and you debit a loss. So one more time, if you're disposing of a fixed asset and it's fully depreciated, you do this. You just debit accumulated depreciation for the full amount and you credit equipment for the full amount. If the asset has not been fully depreciated, you have to first record depreciation, and then once you do that, you're going to debit accumulated depreciation, credit equipment, and then debit the difference between the two to loss and disposal of equipment because you didn't use the asset up fully. If you're not going to dispose of it, you could sell it. So selling has an added step. So with selling it, you are going to debit cash because you're selling it to someone and they're going to pay you cash for it. So cash is increasing. These next two steps stay the same. You're always going to debit accumulated depreciation to take it off your books. You are going to credit the asset to take it off your books. And then this last part, you are going to debit a loss or credit a gain if applicable. And how you determine the gain or loss depends on the selling price and the book value. So if the selling price is more than the book value of the asset, a gain is recorded. So if you're selling it for more than it's worth, that is a gain for you. On the other hand, if the selling price is less than the book value, a loss is going to be recorded. So you're receiving less than what the asset is worth, that is a loss for you. And if the selling price equals book value, you don't have to do anything because that's net zero. You didn't get a gain, you didn't get a loss. It's just you're selling it for book value. So the additional step here is you're debiting cash and then you're also debiting a loss or crediting a gain. And page 506 in the textbook goes over this in more detail if it's still confusing, or feel free to reach out if you have additional questions about this. Okay, now we're going to talk about natural resources. So the process for natural resources is very similar to what we do with fixed assets and depreciation, but it is useful to go through it as well. So natural resources are assets created through natural growth, and they are removed for sale and sold over a period of 1 or more years. So I'm sure you know what natural resources are, but if you're not familiar, it could be coal from a mine, it could be trees that you use for lumber, all sorts of things like that. Instead of depreciation, we record what's called depletion. So the depletion of natural resources. And depletion expense is calculated in a very similar manner to the units of activity method for depreciation. So what you do, you determine your depletion rate, and then you determine your depletion expense by multiplying the depletion rate by the quantity removed over the period. And I'll show you an example of this in the practice problems, but for now, depletion rate is just going to be the cost of the resource. So the cost of a mine that you bought, or the cost of a amount of land with a bunch of trees on it that you're going to harvest. And so it's the cost of the resource divided by the estimated total units of the resource. So the amount of the tons of coal you can mine, or the number of trees you can cut down and use for lumber, etc. So that's your depletion rate, and your depletion expense is just the depletion rate times the quantity removed. And again, I'll go through an example of that in a second, but it's very similar to the units of activity method. And then finally, we talked about tangible assets so far. So equipment, machinery, natural resources. Now we're just going to talk about intangible assets. So these are also longer term assets, but they're just not physical ones. But they're still worth something, they're still assets, so we still have to treat them appropriately. So with intangible assets, we don't depreciate them, we amortize them. So amortization is the decline in usefulness of an intangible asset. Just to review some of the types of intangible assets, it goes through this more in the book, but a patent is the exclusive right to produce and sell goods with one or more features. So I'm sure you're familiar with patents. Patents are going to be amortized. So that's important to note because some of these won't be amortized. Patents are amortized. A copyright is the exclusive right to publish and sell a literary, artistic, or musical composition. And copyrights are also amortized. A trademark is a name, term, or symbol used to identify a business. And trademarks aren't amortized. You don't do anything with them. They just kind of exist. And just in case you weren't familiar, a trademark could be like the Nike symbol or the Apple symbol or something like that. And then we have goodwill. So goodwill is an intangible asset of a business created from favorable factors like location, quality, reputation, or managerial skill. Goodwill usually comes from mergers and acquisitions and that type of activity. So maybe you're acquiring a business and you pay more than what it's, I'm using like quotes here, more than what it's worth. Maybe you're paying a premium like that because you think there's some favorable quality to the business. So maybe it's the reputation of management. Maybe you think they've got something really valuable in that business that you want, so you're willing to pay more. That difference between what the business is worth and the price you pay for it is going to be goodwill. And goodwill is not amortized. It exists on the balance sheet, but it is going to be impaired. So when something happens to goodwill that causes it to decline, we report that as an impairment to goodwill. You can read about that more in the textbook. I don't foresee it being tested too heavily or anything, but if you have questions about it, I'd be happy to go into more detail or discuss it further. But for the purposes of this, you should know amortization is a decline in the usefulness of an intangible asset, and patents and copyrights are amortized, trademarks we don't do anything with, and goodwill is impaired. Okay, that was a lot, so now we're going to do some practice problems. So again, I'm going to run through some of these with you, go through the methods again, go through some depletion problems so you're more comfortable with the material. So this first one has to do with that cost concept we talked about first. So it tells us that a building with an appraisal value of $150,000 is made available at an offer price of $186,000. The purchaser acquires the property for $30,000 in cash, a 90-day note payable for $52,000, and a mortgage amounting to $70,000. The cost basis recorded in the buyer's accounting records to recognize this purchase is, so the cost basis, this kind of goes back to the cost concept from chapter 1, is we record whatever we pay for it. So whatever it costs us to acquire the asset is what the cost is for us. It's not what it's worth on the market, it's not the offer price, it's not the selling price, it's what we paid for it. So the purchaser acquired the property for $30,000 in cash, plus a note payable of $52,000, plus a mortgage of $70,000. So in total, that buyer paid $152,000, and that is what the buyer will record in their books. So that is going to be A. So here, this is extraneous material, and this is as well. They're just there to trick you. We're just focused on what we paid, and what we paid is what we put down in our accounting records. Okay. So, like I did earlier, I'm going to go through the same example, straight line, units of activity, and double declining balance, just to reinforce that concept. So, equipment with a cost of $220,000 has an estimated residual value of $30,000 and an estimated life of 10 years or 19,000 hours. First, we're going to be depreciating using the straight line method. What is the amount of depreciation for the first full year during which the equipment was used 21,000 hours? We don't need that for this method, but we'll use that in the future. So, for the straight line method, our depreciation is going to be our initial cost, so $220,000, minus the residual value of $30,000, divided by the number of years of estimated useful life, and that is 10 years. So that is going to get us $19,000 per year. And that is going to be D. So every year we are going to depreciate the asset for $19,000. That's our initial cost minus the residual value divided by the number of years of useful life. And that is the straight line method. Now we are going to use the units of activity method. So same things, the cost of $220,000, residual value of $30,000, and now we care about this 19,000 hours of useful life, and we care that the equipment was used for $21,000 in the first year. So now we are using the units of activity method, as I said at the beginning. What is the amount of depreciation for the first year? So our depreciation per unit is going to be the cost, $220,000, minus the residual value of $30,000, divided by the total units of activity, so that is going to be 19,000 hours. And if we do that calculation out, we get $10 per hour in depreciation expense. So depreciation for year one is going to be $10 per hour, and then in year one it told us that we use the equipment for 2,100 hours. So our depreciation for year one is going to be $21,000, and that is A. Okay, so that's the units of activity method. And finally, we are going to now use the double declining balance method. So one more time, same figures, initial cost of $220,000, residual value of $30,000, estimated useful life of 10 years, 19,000 hours, and now we're using the double declining balance method. So what is the amount of depreciation for the first full year? So our steps, first is determining the straight line percentage, so that is going to be 100% divided by the number of years of useful life, so that is going to be 100% divided by 10 years is 10%. 2 is our double declining balance rate, and that is going to be the straight line percentage times 2. So 10% times 2 is equal to 20%. And then 3, we're going to multiply our book value times the double declining balance rate. So for year 1, our book value is just going to be our initial cost because we haven't depreciated anything yet. So $220,000 times our 20% double declining balance rate, that is going to get us a depreciation expense of $44,000 for year 1. And then if you were to proceed forward, you just have to remember first that your book value changes each year, and book value is equal to the initial cost minus accumulated depreciation. So for year 2, your book value would be that initial cost of $220,000 minus this $44,000 that you depreciated in year 1, and then you would proceed forward. And then second, you need to remember that you cannot depreciate below residual value. But this was just asking us for year 1 depreciation, and that is $44,000. And finally, we're going to do a depletion problem, so you're familiar with this as well. So, ABC Company purchased mining rights for $250,000. They expect to harvest 1 million tons of ore, so iron ore, over the next 5 years. During the current year, ABC mined 200 tons of ore. The entry to record depletion would include, so depletion, if you remember, is calculated on a per unit basis first. So depletion per unit would be the original cost of the natural resource, and that is the mining rights. So that's $250,000 divided by the number of units to be harvested, or whatever we're going to be using. So in this case, it's tons of ore, and it's 1 million tons of ore can be harvested. So our depletion per unit of ore is going to be 250,000 divided by 1 million tons. So that is going to be 25 cents per ton. And then our depletion, so that's depletion per unit. Our total depletion expense is going to be the 25 cents per ton times the number of tons mined in year 1. So that is 200,000 tons. So that gets us a depletion expense of $50,000. And we're not done there. Then it asks us how we would record that. So you know that depreciation is always depreciation expense is debited and accumulated depreciation is credited. For depletion, it's similar. You are going to debit depletion expense for the amount. So depletion expense is debited for $50,000. And then you are going to credit accumulated depletion for $50,000. So this is your entry, and then you just have to look at the choices. It turns out the answer is going to be C, a debit to depletion expense for $50,000. Okay, that is all I have for you. Chapter 10 has a lot of important content. Hopefully this was helpful, and as always, please feel free to reach out with any additional questions, and I hope you have a great rest of your day.